All right, let's get right into it. We're going to be talking about a multi-trillion-dollar financial product that, chances are, you've probably never heard of. It's called a CLO. And the big question we're going to tackle is this. Is it a work of financial magic, or is it just the 2008 crisis waiting to happen all over again?
But to even begin to understand what a CLO is, we have to start with a kind of weird question. What in the world could old fish possibly have to do with a multi-billion-dollar financial product? It sounds a little crazy, I know, but you've got to stick with me on this because this one analogy, it's the absolute best way to understand one of the most powerful and hidden engines in all of modern finance.
So you might remember this classic bit from the movie The Big Short. The amazing chef Anthony Bourdain, he used this brilliant analogy to explain how Wall Street really works. He said, a chef doesn't just throw away fish that didn't sell. No way. That's just throwing money in the garbage. Instead, a smart chef finds a way to repackage it.
And the method is actually super simple when you break it down. You start with the ingredients that nobody really wanted on their own. Then you kind of disguise them. You chop them all up, mix them together with some spices, and finally, this is the key part, you sell it as a brand new dish. You see, you're not selling leftovers, you're selling a fantastic new seafood stew.
And that is the magic trick right there. You're not actually creating anything new from scratch. You're just changing the perception of it. Through some clever bundling and rebranding, a pile of stuff nobody wanted becomes a hot new menu item. This idea, this kind of financial alchemy, is exactly what you need to hold on to as we go forward.
Okay, so let's move out of the kitchen and onto the trading floor. Because that exact same recipe for seafood stew, it's being used every single day to create something called a collateralized loan obligation, or what everyone just calls a CLO.
So what is a CLO? Well, think of it as a giant basket, and into that basket, a manager buys up hundreds of different corporate loans. We're talking specifically about loans made to companies that are considered, a little bit risky. Then they take that whole basket, all those loans bundled together, and they sell slices of it to big-time investors like pension funds and insurance companies.
So let's just map it out, one-to-one. The week-old fish in our story, that's the equivalent of what are called leveraged loans. Basically, it's just debt from companies that are a bit of a gamble. And that delicious seafood stew that gets sold to hungry customers, well, that's the final CLO security, sold to giant investors who are hungry for returns. See, it's the exact same recipe, just with much, much more expensive ingredients.
Now, this is where it gets even more clever. These financial chefs, they don't just sell one big pot of stew. Oh no, it's much more sophisticated than that. They slice it all up into different servings, and each serving has a very specific level of quality and risk. These slices are called tranches, and they're all designed to appeal to different investors with different appetites for risk. The vast majority of the CLO, the biggest slice of the pie, is the senior tranche. It's engineered to be as safe as humanly possible. Then you have these middle-of-the-road mezzanine slices. And at the very bottom, you have the equity tranche. It's the smallest piece, but it's where all the risk and all the potential for huge returns is concentrated.
Okay, so how does everybody get paid? Well, they call it a waterfall, and for a very good reason. Just imagine all the cash from companies paying back their loans is pouring in from the top. The senior investors at the top, they get paid first. They get every penny they're owed before anyone else sees a dime. Now, what if some of those companies go bust and can't pay their loans? Those losses don't hit the top. Nope, they start at the very bottom, with that equity tranche. It acts like a giant shock absorber, protecting all the layers above it.
This whole process, the bundling of assets, the slicing of the payments, the redirecting of the risk, it has a fancy name, securitization. And its entire goal, the whole reason for this complicated structure, is to create that super safe, AAA-rated senior slice that is protected from pretty much anything short of a total economic catastrophe.
Okay, so we get what they are, and we get how they're built, but why? Why did this market suddenly explode to over $1 trillion? Well, it really comes down to three big things. First, after the 2008 crisis, new rules like the Dodd-Frank Act made it really expensive for banks to keep these kinds of loans on their own books. So banks stepped back, and CLOs jumped in to fill that huge funding gap. Second, these loans have floating interest rates, which is a massive bonus for investors who are worried about inflation. And third, for the last decade or so, we've lived in a world with super low interest rates. Big investors were desperate for better returns, what they call yield, and CLOs offered just that.
And that inflation point, honestly, that's the secret weapon here. Normally, when a central bank raises interest rates to fight inflation, the value of regular bonds gets hammered. But CLOs are totally different. Their payouts actually increase when interest rates go up. For an investor, that makes them one of the best ways to protect their portfolio from being eaten away by inflation.
Which brings us to the final and most important question. If all of this, the bundling, the slicing, the AAA ratings, sounds an awful lot like those toxic CDOs that blew up the global economy back in 2008, well, you're not wrong to be suspicious. So, is this just history repeating itself?
Now, the defenders of CLOs will tell you, no way, this is completely different from 2008. And they'll point to two really critical differences. First, the ingredients are different. We're talking about loans to actual corporations, not those impossible-to-understand subprime mortgages. And second, modern CLOs have a chef in the kitchen. They are actively managed. There's a professional manager who can actually sell a loan that's starting to look bad and buy a better one. The 2008 products, they were just packed up and left to rot.
So what's the verdict here? Is it magic or a house of cards? Well, the reality is the system is definitely more resilient than it was in 2008. The structure has proven itself through some pretty tough times. But the risk hasn't just vanished. The real danger is a deep, long recession, one that causes a massive wave of corporate bankruptcies. Plus, there's another worry, that the huge demand for CLOs is making it a little too easy for risky companies to get loans in the first place.
And this really gets to the heart of the matter. A CLO is a fantastic product if you're the one at the top of that waterfall, buying those super safe slices. But that safety, it isn't created out of thin air. It's manufactured by concentrating all of the potential pain, all of the risk, into those bottom layers. The magic trick of turning risky fish into a 5-star stew means someone eventually has to eat the risky parts.
And that brings us right back to our chef. So far, CLOs have passed every test that's been thrown at them. But it leaves us with one final, nagging question to think about. As this market gets bigger and bigger, is Wall Street's appetite for the seafood stew starting to outpace the supply of good fish?